Hi guys, this is Yao Kai, and we're at Investing with JYK. And today we'll talk about Cameco. Cameco is the biggest traded, public traded uranium miner. So we'll take a look at its resources, um, and then its cash flow position and its balance sheet, and um, have a projection on how the uranium price would affect its earning power. So first of all, as with any kind of resource stock, so any mining stock, the assets are of the utmost importance. If you have a high grade asset, then then your mining costs will be much lower, and then per pound, that is. So if you look at Cameco, the three big resources they have is really Cigar Lake, MacArthur Lake, and Inkai. Inkai is in Kazakhstan. I think it's like half owned by these guys, and then half owned by Kazatomprom, which is the Kazakhstan uranium mining company. So MacArthur River has been running for quite a while, and that is the one that's currently being shut down. MacArthur River, as you can see, this thing has 10% uranium grade. Those are proven, and the probable, typically you just treat them as very similar, because those are, you have very high confidence that the probable reserves are there. So you're looking at something like 370 million pounds. So that's a huge resource, and 10% grade. So 10% grade, what does that mean? So let's just run a simple experiment, right? So 1 ton of ore has 10% U3O8. So that means you got 100 kilograms of that stuff. So 100 kilograms, 2 pounds is 240 something, right? So the current uranium selling price, if you look at UFC, current uranium selling price, it has dropped, but at the lowest point it was something like $20, right? So if we just do 20, that comes out to each ton of ore is worth $4,400. That is a very, very profitable mine. How we know that? So if you look at some kind of gold mines, for example, the Barrick, which is one of the bigger gold miners, take a look at here. In their case, the ores in Nevada is about 2 grams per ton. Okay, so 2 grams, each gram is like 41. Yeah, here we go. So each gram is $41. So 2 grams per ton, you're looking at, say, $100 per ton. Right? And then the gold strike is 3.55 grams per ton. Let's be generous, say this thing is, $150 per ton. And if you look at Cigar Lake, MacArthur Lake, you're looking at $4,000 per ton. So that's a crazy grade. Obviously, MacArthur River is a very expensive mine because there's a lot of environmental issues, and that needs to be controlled. And then the mine construction is also very fancy. It was quite deep down below, and so there's all kinds of issues, and you need like remote controlled carts and all that. So it makes it more expensive, but still, the ore itself is $4,000 at the low uranium price. Imagine if uranium price goes to $60 per ton, right? Then you get $13,000 sorry, $60 per pound, then you get $13,000 per ton of ore. That's crazy numbers. Even crazier is Cigar Lake. If you look at Cigar Lake, this stuff is 16%. Right, so 160 kilograms to pounds is 300, 53. Let's say 20. This is a $7,000 per ton ore. These are just unheard of numbers. So from the point of the asset quality, I would say Cameco is just unbeatable at this moment. There's no any other uranium mine that has such a grade that's currently operating. The triple R, there's a triple R deposit from fission uranium that probably will have comparable grades, but that's not even started developing it. They're still trying to figure out where the ore body is. They have a pretty good idea where it is, but they don't have a complete delineation of the ore body. Now, so we know that Cameco has shut down McArthur River, and they have not shut down Cigar Lake. So one reason is that Cigar Lake it's only recently started operating. It was in 2015 they started mass producing. Right? This is only 2017, so it's only been producing for like 2 years. And also, Cigar Lake is very high in maintenance. The way they produce, the way they build the mine is that they actually had to keep pumping cold brine into these pipes to freeze the soil so they can do the mining. You can imagine that if you stop mining in Cigar Lake, you still have to keep all that stuff pumping, and then Cigar Lake is always leaking. They have about I think they had 2,500. I think 2,500 meter cubed per hour pumps down there, just to keep pumping the water out, because it's right under a lake and that actually keeps leaking. Right, so it's high maintenance, so I understand why they don't want to shut it down. Also, it's higher grade, so it, in some sense, it's in the mining industry, it's called high grading. I'm not sure if this is actually legitimate high grading in terms of in this case of Cameco. I think they made the right choice to shut down McArthur instead of Cigar. I mean, they are clearly more smarter than what I am, but from what I can see, they made the right choice. So, extremely good assets. Now let's look at their financials. So one thing is that we know these uranium miners probably all lose money. So I'm not going to pay much attention to the actual profit. It's mainly can this thing survive until, let's say, within 5 years the uranium market will turn. So the most important thing about that is the balance sheet. So consolidated balance sheet. Oh, come on. Somewhere here. Wrong. I don't understand why is this so hard to just have a thing titled balance sheet. Anyways, let's see. Revenue. This is insane. Excuse me. Woo. Right, here we go. Oh, in Canada they call it the consolidated statements of financial position. Wow. All right, that's a long, it's a mouthful. All right. So you can see that they have about $350 million Canadian dollars, but it's somewhat similar to US, and everything is in Canadian dollars, so it's gonna be apples to apples comparison. And they have inventory that's worth about $1 billion. Account receivable, they probably they will be able to to actually collect, I think, because these are utilities. They won't go bankrupt just like that. And these things, all these non-current asset in this case, it doesn't really matter because you don't want to be selling your assets at the bottom of the cycle. So you kind of have to hold it. So if you hold it, you can't turn it into cash. So we don't care. But overall, they have about $1.9 billion in current assets, right? So current liability is $350 million. So it's a tiny portion of that. We don't worry that much. Long-term debt is about $1.5 billion. But in total, the long-term liability is $2.4 billion, higher than their current assets. But we're not talking about current assets are those that's liquidatable within a year. Right. Current liability, same thing. It's money that has to be paid within a year. These are long-term liabilities that may be 5, maybe 10, maybe 2 years. In any case, you can see just from the balance sheet, they're not going bankrupt anytime soon. But we can't just look at the balance sheet. We also have to look at the change in the balance sheet. The most important part is that are they going to run out of cash? So if you look at the cash flow, right, they lose money for sure. They lose about $100 million in the past 3 months, really. And then 9 months, they lost $143 million. But most of that is actually depreciation. As you can see, most of that is depreciation, which makes sense because once you mine a ore body, the ore actually goes away, disappears. So your ore is constantly burning down. So that's this. Right, and then you got some impairment charges. I haven't checked, but I think the impairment is probably on the inventory, because when they got the inventory, the uranium price might be $30-$40 a pound, and now it's 20. This is the September 30th, right? So that's actually at the bottom of the absolute bottom of uranium price. So cash provided by operations was $153 million. It's positive. That's a good thing. It's not as high as September last year, but it's still positive. And then you replace some of their properties, plants, and equipment. So buying new trucks and all that stuff, $30 million. And then they had to pay $40 million in dividend, pay $14 million in interest, which is actually fairly low. It's about 1/10 of the operating cash flow. Right, so in the end, they still have a positive cash flow here. You can see that. So the increase in cash. If you have an increase in cash and you don't actually see an increase in debt at the same time, and you can see the financing activities, they didn't actually raise debt. They actually paid down some debt. I mean, in here, they raised a little bit of debt. So total last year, 9 months, they raised like 25 million in debt. It's very minor. So this company is not going bankrupt anytime soon, and this company has crazy assets. Now, what are the bad things, right? So I think they had a discussion on. Oh, the other thing is like cost per pound, right? So you can see the cash cost per pound in 2016 is $25, and then 2015 is 28, and that's the operating cost. So that doesn't include, like, does the the mine depreciate or anything. So the depreciating part is here, is covered in here. So once you add the cash operating cost to depreciation and amortization, then you end up with the total operating cost. This operating cost does not include the things like corporate costs, like accounting or the general SG&A stuff. So this is just the mine. It's not all the management stuff. So you're looking at something like $30 per pound for the mine. And I think it was not that much different in 2017. Cost per pound. Yeah, somewhere. It went up to like 40 because they actually shut down. They shut down the MacArthur River, which means they should have I can't figure that out. But essentially now you have the slightly higher cash cost and also higher total cost per pound. So once they shut down MacArthur River, it's going to impact their profitability. They probably lose a little bit more money, but they preserved their fantastic assets instead of selling it out at really, really cheap prices. It's really difficult to make these large discoveries, and nobody wants to sell out at the low prices. So I think they still make the right call. Okay, so when the uranium price increases, what's going to happen? There was a discussion by the CEO. I don't remember where that is. Sensitivity. I think it was right here. So because Cameco mostly operates in a contract environment, so long-term contracts. So even if the uranium spot price increases tomorrow, they're not going to benefit 100% from that. They will benefit a lot, obviously. So you can see from here. So in 2017, 2017 is already gone basically. 2018, if the price is 20, the effective price for Cameco is going to be around 36, and you can see this will keep dropping because they're currently selling a lot of contracts at above 20. As $20 spot drags on, it will drag down. These expired long-term contracts will then get re-established at a lower price, closer to 20. Typically, it will be historically they run at about $10 more than spot. Right, so at $40, they'll get 44, and as you can see, by the time it gets to $60, Cameco will actually get less than the spot. So that means Cameco will benefit quite a lot up until probably somewhere like 55-ish. Beyond that, the price, it becomes a lot less sensitive to the price change. For every $20 change, they get about $10. $20 change in spot, they get a $10 benefit from it. At least in 2018. And even beyond, because all this contracting that's going on. So that's Cameco. The conclusion I would say is that Cameco is a very low risk play for uranium. They have the best assets in the entire world. They have the best liquidity. So they have a lot of cash. They have positive cash flow. They're not going bankrupt anytime soon. So if you buy it, it will not go bankrupt. They are not extremely sensitive to the uptick of uranium. And you saw that the uranium cost for them the all-in cost was somewhere around $30 to $40, right? So anytime, you know, at at up until $40, they're probably going to be quite sensitive to the price, but because they will, that will change their dynamic from losing money on every pound sold to making money on every pound sold. So that's a huge change. But beyond that, they don't benefit fully from the price appreciation. And yeah, so personally, what I do is my majority uranium holding is in Cameco. It's low risk, and even if it's not super sensitive to the uranium price, I think you will be able to benefit. Like, let's say if uranium goes to, say, $80, it's easily a 5x stock, if not 20x, because you're losing money. You go from losing money on every pound to making, in this case, like $30 per pound, right? So that's a huge difference. And then their production, their current production is not very high, but the production, I forgot where that was, but this is 2015 now. Their current production isn't too high, but oops. If we look at this guy, Cameco makes 24 million pounds. Right, so you're looking at 24 times 30 times 1 million divided by billion. So you got essentially you got $0.27 billion in earnings, and per year, and that is actually quite a large portion of its market cap. Currently, it's like $3 billion. So that's why. So that's basically like 5x. Right? So this thing's not going to sell at 5x. And the other good thing about it is the PB is close to 1, I think. Yeah, PB is like 0, is close to 1. So overall, it's undervalued, low risk, not as high return, but I still like it. I will do another one for a different company, and see you guys next time.